Okay, hi everyone. Thank you for coming. So I'm Andrea Abreu Perez. I'm the marketing associate at Tamaya Capital. And here today we have Mark, our VP of Marketing, and Mike Walkinshaw, our Tamaya CEO. And so today we're going to talk about the different VC terms to watch out for. And I'd like to start by asking a question to everyone here. Who hasn't been tempted to just gloss over the finer details of a VC term sheet? They're quite long, right? And I mean, you have worked so hard and now you're just one signature away from getting the capital that you need to grow your business and achieve all the goals that you've set up for your startup. So probably some of us have been in that situation. I haven't, but I think that everyone here knows that ignoring those details can cost us greatly in the future. And that's why we're here. So we'll go over some common terms, but there are many more. And if you'd like to continue the conversation, just reach out to us, follow us on social media, or visit our blog, because we're always updating that list of terms. So for today, we're going to have a short poll, and then we're going to go over the VC terms, and then we'll have a Q&A session for you to ask all the questions that you have. So Mark, what else do we have to know before getting started?
Thanks, Andrea. Yeah, a couple things. So as I mentioned at the top, definitely stay involved with us through the Q&A panel. We'll try to get to those to the end. And also on Twitter, you can use the hashtag VC terms. This isn't a comprehensive list. So we'd like to hear from you guys, the entrepreneurs. What are you looking at? What are you struggling with, and where do you have the most questions? So these are the terms that we think are the ones to really look out for. Mike's been through both sides, and we talk to entrepreneurs. We're talking to dozens or hundreds of entrepreneurs every month, and they're looking at equity options. So just want to make sure that everyone's educated before making a decision. So just to help us frame the conversation, we're going to start with a poll. We got two questions here. So the first is what size is your company? And the second is what terms to cover. So I'm just going to launch that poll. So if you can just give us a quick answer of where you guys are at, that'll help us tailor the conversation, especially with which terms you're most focused on. So maybe we can skip through some ones that aren't as popular. Does everyone see that poll arrive? Oh yeah, here we go. We got some responses coming in now. So it looks like participating preferred stock is a pretty popular one. It's currently the most popular question. We've got a mix of people in terms of size of company. Board seats also very popular. An anti-dilution protection, that's very popular as well. Just over halfway here of people submitting their responses. Yeah, so pretty common. So a general mix of size of companies here. And the most popular one is participating preferred stock. So yeah, we're going to get into that right off the top. And then also anti-dilution protection. So I'm going to end the poll here and we'll dig in. All right. So here we go. Participating preferred stock, which we like to call a double dip. that combined with a liquidation preference, which is our second topic, can be very destructive for the equity stack of your company. So this is a strong example. What it means basically is the VC gets to take their money back first, and the founders will basically split after the VC gets their money back. So that's essentially what we call participating preferred stock. So this example here shows that if they do that, it's the founders taking the short end of the stick on a sale of a company at 30 million. So you can argue this, you can negotiate this, talk to the equity providers that you're dealing with and negotiate perhaps if you hit a certain exit, then this gets reduced. Definitely, we recommend talking to an advisor as well about this, and also us. We're open to having a look at your term sheet and seeing what that is. You could just push it off a little bit, so to put yourself in a better negotiating position down the road.
Mark, can I go back and just hop in there on that for a sec?
Yeah, jump in.
You don't mind? One of the themes that's going to come up over and over again through this conversation is the concept of these terms having an original purpose and then them evolving into what is common practice today. And I think it's important for the crowd to understand the evolution of that. So the original purpose of participation was that the VC would, in fact, get their money back first. So if the company was ultimately not very successful, that they would have a chance to get their money back first. However, it evolved over time to the point where even in successful companies, they still got their money back first, and then they get a share of the rest. So the way to negotiate this and to really go after this from the perspective of the underlying entrepreneur is to really push hard on what the original intention about a participation was, and then try and negotiate away the rest of the situation where they're getting their money back, even in good situations. And so the easy way to think about it is to turn a participation from an and into an or. So if the company has a bad outcome, then yes, they can have their money back first. But if it's a good outcome, you don't get your participation. You just get what everybody else gets. So that's the way to attack that from the perspective of the entrepreneur, is to push away on the and condition and make it an or condition.
Thanks, Mike. So that combined with liquidation preference as well, that can be quite deadly, because if they have access to liquidate first, depending on the sale and depending on how many rounds of VC investment can happen, they can have their preferred stock, and they can have liquidation preferences. So they'll get 100% of their cash first, even if the growth of the company isn't as expected, perhaps on a down round or perhaps on a down exit. The VCs can just get their money back 100%. So these two things combined can be quite deadly. Mike, do you have anything to add?
No, same condition. It's those two work together in tandem, and it is the best attack on that is to negotiate it into an or condition, not an and condition. Yeah,
right on. Next item, board seats. Andrea, take it away.
Yeah, so board seats, they're not just chairs. They're especially dangerous when you have, let's say, an investor that owns 25% of your company and 20% of the board, because over time, their ownership percentage will be reduced, but their control over the board will remain the same. So let's say that we're combining board seats with veto rights. Then you have an investor that has an unbalanced control over your company. And because it's your company, what you can do instead is to ask the VC investor to take board observer rights. And you may want to talk to your advisor and see how you can find a way out of it before signing the term sheet. So before signing anything, that's when you have some leverage and control, and you can add any other conditions, like what Mike mentioned of the or. So for board seats is board observer rights. Another condition that we want to talk about is warrants. We typically see them in early stage deals, and they're presented in lieu of cash. At Tamaya Capital, we calculate that the cost of a warrant can be between 3 and 4 percentage points each year. So if you have an aggressive growth strategy, they can be very expensive because they allow investors to buy those shares at their founder's expense. So at a price that is set up right now, but cash out much later. Let's say your company becomes super successful, they become very expensive. And unfortunately, in the VC world, they're very common. So it's important that you understand the value that a warrant has and what you're giving up when you're agreeing to them. And if you would like to completely avoid warrants, then you need to look at alternative providers of capital. Some alternative providers of capital, though, that provide non-dilutive capital options, they also offer warrants. For example, at Tamaya Capital, we don't. And I think that's one of the advantages that we have and offer. The other condition that I would like to talk about is veto rights. So veto rights, they're stipulations that are used by VC firms to have a say over your company in different situations. And they're especially dangerous when you're looking at an exit or redirection of your business, because they just block your decision-making power. And if your company is achieving the growth that you think is going to happen, then you need to ask that veto rights come to an end once the VC achieves the multiple that they're looking for, and try to negotiate that. So in all the terms that we're going through, negotiation is a key aspect of that. Yeah, so Mark or Mike, would you like to add on the terms that I mentioned, or should we go on?
Well, often one of the things you can negotiate on veto rights is, for example, the VC will ask for a veto right over a use of debt in your company, for example, and they'll put a dollar value on any debt over, say, $100,000 that the management team chooses to take on, needs to be then approved by the VC. Sometimes the condition itself can't be negotiated, but the dollar value can be negotiated. So you can argue for a much higher dollar threshold, like $1 million or $500,000, and you can ask why, the VC investor, which is an equity investor in your company, feels that management isn't capable of making these decisions on themselves by themselves for $100,000 or $500,000, and you can often push up the dollar threshold and thus give yourself more degrees of freedom.
Yeah, Mike, just want to stay here for one more second, just because in our poll, we had lots of people interested in veto rights and board seats. So these two things paired together can be dangerous, especially if you end up giving a board seat or a veto right to a very early on investor that gets quite a large stake in the board. But if after multiple rounds or after years of growth, maybe their percentage of the board ownership may not reflect their actual ownership.
Yeah, what's fair is that the board is roughly composed of pro rata percentage of company equity ownership. So, if a VC owns 20% of a company, then it's reasonable to expect that they would own 20% of the board seats. That's not often how it works. Often you will have, a VC that owns 20% and then say diluted down to 15%, but they still own 2 seats out of 5 and end up with 40% voting control through the board. So being very mindful of that ratio between what they own for an equity percentage and the number of seats they actually own on the board is extremely important. And as Mark, as you said, as you go through multiple rounds of financing and you start to add a B series and a C series, you know, and maybe your company isn't doing so well in the A, and so you kind of got to do an A2 before you go to a B round. Those dynamics become a lot more complicated, and everybody wants to hang on to their board seat. And so you find yourself in a situation where you just keep adding more and more board members. And then the dynamics get all out of whack. So actively managing how many board members you have and who controls the board, and whether that still reflects the underlying equity ownership of the company through multiple rounds, is really very difficult, but is something that, you know, CEOs, entrepreneurs should spend a lot of time focusing on.
Thanks for that, Mike. Let us know there in the chat or the Q&A section if we have any more questions. So we're going to move on. So the next topic we're going to talk about is stock option issues. So most VCs will want to carve out enough options for things like board seats, employees, board members, future rounds, et cetera, et cetera. Quite often, they will argue that it should come out of the founder's share. And especially early on, when your valuations might not be the strongest, you could lose a lot in that first couple rounds of financing. And the VCs will insist that you have a strong segment that is for your employee stock option plan, your board seat plan, et cetera. So that typically comes out of the founder's share. So what we recommend is look through how those shares can be distributed out a few years or a few financing rounds or to your planned event. But then also consider what might happen if things don't go exactly the way that you want to, and see how those options will be split out. Next up is the right of first refusal. So this is as it's described. These are often in early term sheets and will allow the investors the power to restrict founders from doing what they want, especially pertinent to selling shares. So one thing that we'll often recommend with this clause is to offer the founder to share those share those options with family members or for estate planning, or selling small percentages. So allow the founder to sell maybe 5 or 10% of their shares rather than just blocking it entirely. That is the most common. The other thing that you can do here is negotiate that right of first refusal changes based on growth, based on size of the company, based on valuation. Mike, do you want to take this one?
Yeah, anti-dilution protection is a term that's often in term sheets, but is very rarely ever actually used down the line. However, it does cause a lot of significant battles in future rounds between investors and between the management team and investors. And as such, it should be taken very seriously and should be carefully negotiated. So what it means is, if I invest in your company in a Series A and I give you $2 million for 20% of your company, and then in the future, your company's not doing so well and you need more financing, and let's say you go out and raise more money at a $5 million valuation, well, I get to adjust the number of shares I'm holding simply because you went and issued shares at a much lower price in the future. So the problem with the clause is that if I threaten to use the clause as your existing investor, that will deter almost every new investor from ever investing in your company, because they don't want to have me get a whole lot more of the company. And what's worse is, generally speaking, it ends up coming out of the backs of the founder, not out of other investors. And as such, you, the founder, end up with a much smaller part of the company, and the investors end up with more of the company. And I think, statistically speaking, it's pretty well proven that companies where the founders don't own a lot of the company don't really do all that well. So every investor wants, especially every new investor, wants founders to own a good portion of the company. So when you get into anti-dilution, there's a lot of really technical math that goes into how these work, and there are multiple different ways. So let's move to the next slide, if you don't mind. There are a number of different ways that you can modify the calculation to make it less offensive. You can also have a very honest conversation with the VC that would be somewhere along the lines of, come on, let's both admit that this never, ever, ever gets used. So, and try and negotiate it out. But the most common way is to avoid the full ratchet and move to what's called a weighted average ratchet, which then avoids the worst cases of anti-dilution clauses. This is something where you're going to want to seek some guidance from somebody who's been through these term sheet negotiations before with this particular clause, because this one does get very complicated, and a lot of gobbledygook in that particular clause. Next.
That's a good one. All right, so this is kind of a twofold, two terms at once. So a drag along rights and also co-sale rights. Mike?
Yeah, and this kind of goes along with the right of first refusal conversation earlier too. So drag along rights, co-sale rights particularly apply to investors, it applies to everybody, but they're generally speaking written so that one investor can force another investor to do something or not do something. And what it means is, if I'm an investor in your company and I decide to sell my stock to somebody else, then all the other investors have rights associated with that sale, which means they can force the buyer to buy their shares at the same price that I'm selling my shares. And often, so that's your co-sale right. And often what that does is the simple existence of a co-sale right prevents anybody from selling any stock ever, because no buyer is going to go through that whole rigmarole of deciding whether they want to buy the stock once they come to the understanding that there's a co-sale right there, because they're not interested in buying the whole company. They only want to buy like 10% of the company or something. Now, drag along rights are a little more realistic, and the purpose of a drag along right is if 70% of the investors in the company decide they want to sell the company, and 30% say, I don't. Maybe they don't like the price, or maybe it's the founder who just wants to keep, running the company. Then a vote of 70% will allow the dragging along of the 30% who don't want to sell, in which case they are forced to sell. So it prevents, say, one or two shareholders from stopping or preventing the sale of a company. That one, I'm less personally concerned about it. And I think it's probably a good provision, because you don't want to find yourself in a situation where 70% want to sell and 30% don't, unless of course you, the founder, are the 30%. But generally speaking, you want to have sort of a super majority situation where you can sell. However, co-sale rights are a different matter, and you definitely want to be concerned about co-sale rights and try and think about what we can do to allow people to maybe sell some stock, sell little bits of stock, still less than 5%, transfer it between estate companies and stuff without those co-sale rights applying to their transaction.
Mike, we got a good question here. What document would we find the definition or distinction of the minority versus majority shareholders?
So I'm not sure I understand the question exactly, but I'll answer it. And then
So I think what they're looking for is where would they find their own list of shareholders, minority versus majority?
So two answers. One, first of all of the share class rights are contained in the articles of the company, which should be publicly available. If not publicly available, it's available to all shareholders of the company. So the articles will lay out things like, what the terms are of the preferred shares. Are they participating? Are they not participating? Second, co-sale rights and drag-along rights will be contained, are not things that end up in articles of incorporation. Those are things that are legal rights that are negotiated between the shareholders, and those are contained in a shareholders agreement, or what's commonly referred to as a SHAG. And that is where all of the major and sometimes all of the minor shareholders sign the agreement, and it's a legal agreement among the parties. And there they would agree to co-sale rights and drag-along rights, et cetera, et cetera. And then I think the third answer to the question is, if you want to find out how many shares are owned by every person, that is contained in the cap table, capitalization table of the company. And that is sometimes pretty jealously guarded by the management team, and is sort of not information that's public. But you should be able to get some measure of information. If you're an investor in the company, you should be able to get a small investor in a company, it's like say an angel investor in the company. You should be able to get a cap table that tells you how many shares are issued to whom, and what percentage of the company each person has, and thus what the voting percentages will be when any hard decisions need to be made. Let me know if that answers your question.
We could probably do a standalone blog post just on this topic. So maybe we'll look at doing that in the future.
So yeah, go ahead.
In the essence of, just respecting time, let's just move on to our next topic.
Okay. Redemption rights, another clause that is usually embedded in a term sheet, but almost never used. So the redemption right is, I'm a preferred shareholder and I come to you and I say, I'm going to give you $2 million for 20% of your company. And then buried somewhere in the very back of the term sheet says that if I choose, after 5 years, I get my $2 million back. You have to pay me my $2 million back with 30 days notice. And so, why is that a problem? Well, it's only ever going to get exercised if the company is doing terribly. So after 5 years, you've done nothing, you've spent all the money, company hasn't really gone anywhere. And the investor is saying, well, I don't really like what's going on. The problem is that often there's no cash in the company. And so the investor puts the redemption clause on the table and gives you 30 days notice, but you don't have any money to pay it back. So it's often a clause that's used when companies are sort of near the end of their life and sort of in trouble, and does force some sort of bad behavior. The better pathway for the investor, often the use of it, is to force the management team and the other investors to put the company up for sale, at which point everybody gets exited under all the other terms of the share capital. And very rarely does anybody actually ever get their money back on it. So let's talk about, how we might negotiate that a little bit. You could try and get rid of the clause completely. And in fact, you can use an argument that says that if you put that clause in there, then on our financial statements, this actually isn't going to be recorded as equity. It's actually going to be recorded as debt. Because if you have a redemption clause, it starts to look more like debt rather than equity. And So that might mischaracterize the kind of money you're coming in, and it might cause you some problems or not, might not cause you some problems. It really depends. You can put timeframes on them so that, you know, it has to be at least 5 years before it gets exercised. And you can often do things like limit the redemption price. So they'll push for the original $2 million plus 12% a year, so that at the end of 5 years, it ends up being kind of like $3 million. You can push down the amount and just say, look, let's both agree you're only going to get your money back. So let's just agree that $2 million is the maximum. So there you go.
Thanks, Mike. Couple last ones that we can cover somewhat quickly.
Yep. So pro rata participation rights. I own 20% of your company. You go to do a new round of financing, and I have the de facto right to buy 20% of this new financing round. Sometimes people care, sometimes people don't care. Sometimes it's a great thing that your existing investors want to put more money into your company. Sometimes they don't. Where it is a problem is only if you have a large strategic investor, for example, who wants to buy 100% of the round, and now you have one investor who says, no, I want to buy 20% of the round. So it can sometimes be a little bit of a problem to have that, but generally speaking, never a problem to have your investors who want to invest in the next round. Giving them the right, again, it's a term I've never seen formally exercised. It's always a negotiation between the investors around the table, around the board table. And very rarely have I don't know if I've ever seen anybody actually formally exercise a pro rata right, but it is in a lot of term sheets.
Mike, I think that's a good point. Just because you got a term sheet in front of you doesn't mean you have to sign it. Everything is negotiable. And I think that's one strong takeaway of all these terms we're going over today.
Yeah, they often are the starting point for more complicated negotiations that happen afterwards.
Okay, what about insurance?
Well, yeah, so insurance obligations are, I'm going to take life insurance out on the CEO of the company because I think that person is so incredibly important that if they get hit by a bus, insurance gets paid, insurance flows to me, the investor, I get my money back, and then we shut the company down. So not an unfair request if it is a small company, not an unfair request if there is one very key person to the organization, but perhaps those obligations could disappear over time as you move to a company that has a broad management team with a bunch of key people. There's no reason to have that kind of obligation on a $10 million revenue company that has 4 senior management team members. So I think there's a time and a place for these insurance obligations, but sometimes they get brought in and then they just get left in, and they're always there, and maybe not the best use of capital for to pay the premiums on that.
Yeah,
when the company has grown past a certain size.
Yeah.
Moving on. What happened to number 13? We missed number 13.
Oh, I think number 11. We had 2 number 11s.
Anyway, we did.
Right, 2 number 11s. Yeah.
So finally, the last thing is the expenses of the venture investors. Often a difficult thing to negotiate because you're looking for capital, but it's important to understand that venture investors in particular have limited partners behind them who've given them money and who give them a management fee to cover expenses. And so sometimes venture investors, it's possible that they might be trying to double dip themselves by recovering expenses from you and then keeping the management fee for themselves as sort of salary and bonuses and stuff.
Right.
It is a very fair question to ask, why am I paying for this expense? And to understand how that might work within the entire framework of limited partner, general partner, the investee company.
Mm-hmm.
And it's one of those things that creeps over time, and it changes depending on how competitive the environment is. And there's no real hard and fast rules, and it is completely negotiable what is covered and what is not covered.
Well, that was quite a lot that we went over today. Thanks, Mike, Andrea, and our participants here on the line. It is quite a lot to get an equity term sheet and have a full understanding of what it means for your company going forward, regardless of whether your company is massively successful and is a rocket ship, or maybe it doesn't, hit some storms and doesn't grow as expected. The thing to note here is you have to understand that equity providers, VCs, are really, really good at what they do. They're doing this every single day. Founders, on the other hand, are not. Founders only go through financing rounds when they need it or when they want it. And so it's very important to understand where you're at, where you'd like to be, and how that equity financing will impact your business. So do seek out an advisor, talk to your lawyers, talk to your accountants, talk to other capital providers, and get a good understanding of where you're going to go.
So what you can do is to try alternative forms of finance, such as non-dilutive capital. Usually the providers that give you like an upfront cash injection of 3 to 9 months of your current MRR. And the advantage is that there are multiple payback options. At Tamara Capital, we have a transparent structure. We don't take board seats. We don't ask for warrants. And you can negotiate kind of everything else. But I think one of the biggest advantages is that you get to keep control of your company. Yeah.
And that's really important. You get to keep control and ownership of your company. And we are very entrepreneur-centric here at Tamaya. And we believe that if you believe in your company, why would you dilute yourself? And we have lots of people in our organization and people who have taken our capital who believe that as well. So we'd encourage you to reach out to us and ask us some questions, or reach out to people who have worked with us in the past as well, and see what it's like to work with us. So that is pretty much the end of the webinar here. We've got 10 more minutes on the calendar invite. So if you do have any additional questions, we appreciate the questions being asked through the webinar up to this point. But we are always around wanting to put the entrepreneur, in the driver's seat, in control of their company. So if you have any additional questions, you can ask us now. And as Tony and Yaz and a few other people have asked, yes, we are recording at the moment. Once I get the notification, I'll package it up to be sent out. We did cover these topics at SaaStr and had some great feedback live, which encouraged us to do more with these topics. We realized that this is something that entrepreneurs need to know more about. And so we will continuously update our blog. There's a link in the chat right now to our blog post covering some of these, not as in-depth as Mike went into earlier, but we will focus on putting out some more educational content on the ones that had more interest. With that, Andrea, Mike, thanks for being here. Catherine, thanks for having us.